Hi there, welcome to our webinar today. And this webinar is really a reaction and trying to be proactive as well. And you can't really be proactive and reactive at the same time, but we're going to attempt to do so. In our current economic situation, I felt that this is an extremely important webinar to address, to kind of bring us all back to ground zero, if you will, to really kind of get an idea of what's our next steps. Okay, what's our next steps? So before we get into that, let me go ahead and explain who I am. My name is Robert Wolf. I've been a financial advisor, if you will, an insurance advisor, real estate coach, asset coach, since 2001. That's why I call myself an asset coach and a tax strategist. Really what our goal is, and I'll explain this in a second, what an asset coach and a tax strategist does. Our goal is to help educate and explain to you what you have and how to build what you currently have into what you actually really want. Not getting the same off-the-shelf advice that we always get, and so hopefully you'll see that as we go through here. I'm a business owner as well, so I understand some of the pains and sufferings that you're going through. I'm an author. I wrote this book, Economic Termites. Really addresses what I call economic termites are. We know what termites are, and we know when the damage has been already done when we find out we do have termites. Economically, we have the same type of situation. The top four economic termites written in this book and explained in this book are taxes, inflation, time, and laws and regulations. And the crazy thing is that we're really starting to see all four of those, and the fifth one is debt. So we're really seeing all five of these economic termites go into effect right now to deal with our current economic situation with the coronavirus or a pandemic, if you want to call it that. So this is extremely important to understand what we're trying to accomplish here. And then, of course, I'm a husband of over 20 years and a father of 3. So I understand from a father's perspective, a husband's perspective of how do we deal with our current situation. So what is an asset coach and a tax strategist? Well, in sum it up pretty basically, I help or teach you how to organize your assets to work more efficiently while receiving additional tax savings, which causes those assets to work even harder for you without increasing unnecessary risk. And that's the key, is without increasing unnecessary risk. A lot of the advice given out today, if you want to get a better rate of return, if I can use that term, or if you want to get a better investment, or you want to make more money, risk reward is the adage, is the term. And how do we get more reward without taking more risk? And so that's essentially what we're going to discuss. Now, keep in mind though, please understand that this is educational purposes only. There is risk inherited with everything. It's just a matter of understanding that risk and what kind of risk do you want to, or are you comfortable with planning for. That's the key. And so we have a system in place that will walk you through the steps of how we accomplish this. Now, what do I do now is the big question, right? What do I do now? Well, what you're going to learn from this webinar is 3 things. What does the stimulus packages mean to me long term? These stimulus packages that are being issued by the government right now, what do they mean to you right now? That's a big question. And because this is long term, we're in the here and now, but these stimulus packages are going to affect us individually and our country long term. Back to my book, Economic Termites, and how we address that. Now, how do you prepare for the future in this new environment? That's the big key. And I know a lot of people are worried about right now, but the reality is that right now is just a fleeting. The future is now, right? And so we do in 3 months, 5 months, towards the end of the year, how do we plan for this? What do we do? And we're all at different situations, and that's the key that we want to address here. And what actions should I take? Okay, so let's talk about, what does the IRS tax? Okay, let's keep this basic. They tax income, right? And so what creates income? Assets. So because you create income, whether it's a W-2 income or some kind of income from owning a business or whatever the case may be, you're an asset. You're an asset to the IRS because they tax income. And so that's important to understand, because now we want to know what kind of income I want. What kind of income do you want? Do you want taxable income or tax-free income? This is not a trick question, by the way. You can answer it truthfully. If you want taxable income, say taxable. But if you want tax-free income, say tax-free. So the key is, if we know assets create income, what kind of assets do I want if I want taxable or tax-free income? If I want tax-free income, I want tax-efficient assets. I want to figure out what assets are going to be the most tax-efficient. And you'll find from this webinar why this is so important. So the IRS does lay out 3 most efficient assets that provide what I call the 3 Ds: deductions, depreciation, and distributions. And we're going to talk about some of this as we go through this webinar and understanding what this actually means for you. So what does the stimulus package mean to me long term? Let's address this. Well, the federal deficit currently is 24 trillion. That's right, trillion. Thousand, million, billion, trillion. So how do we get there? Well, if you go to us.clock.org, and let's address this. Let's look at this, okay? So right now we have $24 trillion. This is as of April 9th, 2020. We have $4 trillion in national debt. Debt per citizen is almost 73,000. Debt per taxpayer is a lot higher because not every citizen is a taxpayer. So, and I don't mean anything bad by that, because you have children that lumped into this. You have some people that are citizens, but they don't earn an income, or they're unable to, right? They may be on a disability of some sort. So each taxpayer is responsible for $193,000. Now, obviously, we're not responsible for it, but that's essentially what this is saying, right? So imagine you go to work January 1st and you've got a national debt of $193,000, and not including your own personal situation. So it's kind of a big deal to look at when you look at the numbers from this perspective. Now, look at our federal debt to income ratio. Now, when you bought your house, right, in order to qualify for a loan, they have a debt to income ratio, right? Why? Because the bank wants to make sure that you're able to pay them back. Well, take a look at this. The debt to income ratio for the national government now is almost 111%. Look at that. Please absorb this. The government does not follow what the rest of the economy preaches. Okay, and so let's take a look at something maybe a little bit more positive. Let's look at the income the government generates. So the U.S. federal tax revenue, okay, so it's $3.3 trillion, almost $3.4 trillion. Okay, so it's about $10,000 per citizen. Now, here's the interesting thing about this whole thing, is that look how much revenue is generated from income tax, $1.6 trillion. Now, look at how much is generated from payroll tax, $1.2 trillion. What is the CARES Act that was just passed? What's that do? It basically, you can get a loan or borrow to pay for the payroll. So basically, the government is deferring this for later on. This is $1.2 trillion, okay? Significant. Look at the corporate tax revenue, $219 billion. Look at the tariffs, almost just under $67 billion in tariffs. Okay, so this is a really big deal to understand how the revenue is generated. So the U.S. gross domestic product is 21 trillion. Okay, so and we're in debt 24 trillion. All right, so this is a big deal. Now, what we want to do is understand what has to happen to tax rates. If we're this far in debt, what has to happen to tax rates? How do we increase revenue? They either go up or they go down. There's only 2 ways the government generates income or revenue: through taxes or borrowing. Okay? Now, when they borrow from other countries invest in the U.S., and we're borrowing those dollars, right? And so how do we have to pay that back? It has an interest. How do we generate revenue to pay interest? Taxes and borrow. Rinse and repeat. Those are the only 2 ways, my friends. So that's a big deal. So what has to happen to tax rates? They have to either go up or they go down, right? If they go down, that means less revenue, more borrowing, which means less revenue, more borrow. So you see the vicious cycle. So they have to go up. So now, what else are you going to learn from this webinar? So we just talked about what the stimulus package means to you long term. So how do we prepare? How do I prepare for the future in this new environment? So let's discuss that. Again, IRS taxes income, assets create income. What kind of assets do you, or income do you want? So what kind of assets do you want? And then the three most efficient assets are assets that provide deductions, depreciation, and distribution. So let's discuss this. How do I prepare for the future in this new environment? Well, again, I'm pounding this home. What kind of income do you want? Taxable or tax-free? So we got to look for those types of assets. So what will eat away at your assets quickly? Market fluctuations, taxes, fees, and inflation, right? And the two most are the market fluctuations and taxes. Why do I say that? Well, because think about it. Where's most people putting their money away for retirement? Into retirement accounts. And where, if you have a 401k plan or an IRA at the bank or with an advisor at your company, wherever, where are they putting those dollars? Typically, they're putting those dollars into the market, right? Stocks, bonds, mutual funds, ETFs, whatever, right? Now, I'm not saying that that's bad or that's good. That's the reality of it, isn't it? So if you're putting your money into those, you have to understand your risk tolerance, and there's a whole bunch of financial planning terminology and planning that you got to go through to understand what makes the most sense of where you put your dollars. And so when you take those dollars out, they're going to be taxed. Your 401k, your IRA money, those are dollars that you haven't paid taxes on. So you're going to have to pay taxes on those when you start taking it out later on when you want it. So in like this current situation, let's say I'm retired, I'm taking income out, and the market goes down 20% in a month like it did. Okay? What happens to my assets? They go down 20%. So if I'm taking income out of there also, so I'm taking income out of, did my expenses drop by 20% in that same month? No, they didn't. So I still need the same type of income, don't I? So I'm taking out the same type of income out of a there's less money in that bucket, and I still have to pay taxes on it. So what happens later on when you're in this situation and taxes go up? You got to take more income out, don't you? Because your expenses, you still got to pay for your expenses. Your expenses are net of your income, which means they're net of the taxes that you have to pay on that income. Okay? So then fees and inflations are other areas. So having a tax-free bucket is not negatively affected by the market fluctuations is extremely important. How do we develop a tax-free bucket that's not negatively affected by market fluctuations? And that, my friends, is what we're going to discuss. It's vitally important, okay? Vitally important that you start planning for these buckets if you don't have these buckets. If you do, it's just vitally important to understand what those buckets look like and how they'll perform moving forward. Okay, how do we get them to work more efficiently? And that was the definition of an asset coach and a tax strategist. How do we get what we have working more efficiently? And if we can design something that can help us alleviate some of the taxes that we're going to end up having to pay in the future years, then we got to understand those. Now, these aren't my rules. These are the IRS's rules, by the way, right? Those are the games that we play is based on how the IRS lays out the rules. You look at football, they have rules. You got to play by the rules, right? Basketball, play by the rules. Racing, playground, right? School, driving. That we all have rules that we have to play by. If we break those rules, then we get penalized. So the key is understanding the rules. And that's here is what the biggest situation and concern is, that most people don't understand the rules. So that's what we do, is we're going to teach you the rules, how to play the game so you can abide by the rules and be benefited by those rules that are laid out. That's not a bad thing. You hear bad things because people aren't playing by the rules. So let's figure out how to create these buckets, okay, by understanding the rules. So here are some of the areas in the buckets that provide tax-free income: Roth IRA, municipal bonds, treasury bonds. Now with treasury bonds, some states, if you have income tax states, that's not a tax-free bucket, but we're talking from more of a federal perspective, okay? And real estate and cash value life insurance. Now, these bottom two, real estate and cash value life insurance, are the two most really efficient based on market fluctuations, based on risks. But now let me make this very clear. Properly structured, a plan that understands and lays out the rules for both of these assets. Now, we're talking about assets, Okay, so when we're talking about real estate, how do we create it as an asset? We're not talking about your family home. Your family home is not an asset. Why? What's an asset providing? Income. Your family home is not giving you income. Okay, now cash value life insurance, we're not talking about life insurance. We're talking about cash value life insurance. There's a big difference. So let's discuss how they're similar. When you were looking at real estate and life insurance, cash value life insurance, they both have a particular value. For real estate, the value is the property. For life insurance, it is the death benefit. Okay? And we make contributions, so you get a loan for your real estate, right? And you make your payments. For life insurance, they're premium, and you make your payments. Those are both contributions. Now, you can do lump sums on each of these, right? Now, both of them generate equity. Now, depending on the type of real estate you have, depends on the type of equity buildup. Depending on the kind of life insurance you have, cash value life insurance depends on the equity buildup. Both can generate income. Depending on how it's structured, the life insurance and the real estate, you can generate income. And both can be transferred to other types of properties, real estate, or other types of life insurance, or can be transferred to the next generation at death more efficiently as well. And they're both extremely tax efficient when we're talking about all these previous areas: value, contributions, equity, income, and transfer. We can make them tax efficient for both of these, okay? So there's a lot of similarities to these. And in our practice, what we do is we use both of these. You don't just use one, because not everything is, there's no perfect asset. There's no silver bullet. There's pros and cons to everything. And again, it's understanding the rules. So when you understand the rules to these two assets, how combining them together, you limit the cons much more and you enhance the pros much more. But there has to be a plan that is laid out that focuses on how to accumulate or how to approach this. All right? It's very, very, very important. Now, there's two purchase options when you talk about both of these. You can use your cash, or you can borrow, or you can do both. Okay? There's ways, and it depends on your situation. So these are not blanket statements. Okay? It depends on your situation, on how much cash you use and how much you borrow on each of these. Okay? It's extremely important to understand. And so we'll talk about this later on what actions to take on how we go about understanding this more. So again, what kind of income do I want? Taxable or tax-free? And what kind of assets do I want? I want tax efficient. So let's talk about, most people understand a little bit about real estate. Okay, we're not going to go into the details of how we design a plan and by the rules on the real estate side. Most people have a general understanding of real estate. Most people do not have a general understanding of cash value life insurance. So that's what I'm going to talk about now, is talk about the efficiencies and how we view and how we look at the very basics of cash value life insurance. And the way we got to do that is through this analogy here of multitasking of a dollar. Then after this is where we talk about the different types of life insurance that's out there, okay? And so that's extremely important. So if you're thinking about leaving this webinar because I keep talking about life insurance, you're making a huge mistake. Do not. I'm talking hundreds of thousands, if not millions of dollars mistake if you leave right now, okay? Please stay on for your own benefit. Please stay on for your own benefit. So if I had $1, so we always talk about multitasking, right? We always joke about how men are very poor at multitasking and women are better at multitasking. So if I have $1, I want that dollar to multitask. I want to do as much as it possibly can. So with cash value life insurance, it has a death benefit. It's life insurance. Yes. Oh my goodness. Well, if you die, guess what? I've never known anybody, and I've never read an article anywhere that when someone was passing away, they say, boy, I wish I had less life insurance. Right? So now that's catastrophic, right? That's the end of the road. That's horrible. And I get that. I understand that. Okay? But the life insurance, the dollar still pays for the life insurance, still pays for the death benefit. Okay? Now, we have something we call living benefits. And the first living benefit is what we call terminal illness. And what this says is that depending on the insurance company, the insurance carrier, if you are meeting with a licensed physician and they tell you that you have anywhere from 12 or 24 months, depends on the carrier, left to live, okay, you actually have access to anywhere from 65 to 85% of the death benefit ahead of time. So yes, you can file a claim sooner than actually passing away. Now, why would we do this if we're terminally ill? Well, maybe there's medication, experimental medication you cannot afford and health insurance doesn't pay for it. Well, here's a way that you could possibly afford it. What if you finally, you just say, you know what? I just want to be with the family. And let's just pay for all the family to go away for a week or 2 weeks together so I can spend time with my family. Fine, do it. It's your money. You decide on how you want to use it. But this is a living benefit. It comes with the policy. So that dollar is giving you access to that. Now, another area of living benefit is what we call chronic illness. Chronic illness is in some states is considered long-term care. In other states, we have to use the term chronic illness. But basically, it's a percentage of the death benefit. And its definition is if you can't perform 2 of the daily 6 activities of daily living, ADLs, then you have access to this. Again, it's a percentage of the death benefit. Now, the percentage depends on the carrier, depends on the policy, and it depends on if you've already accessed some of the death benefit. Okay, so because we also have what's another one called critical illness. So all of a sudden your dollar's doing 4 separate things now. Critical illness is a stroke, heart attack, cancer. Now, in this environment, actually, it'll also cover for coronavirus depending on the carrier. Okay, and let me make that very clear. Depending on the carrier. These are not blanket statements for everything. It really depends on the research and the development of which carriers are going to do what's important to you. But why is critical illness so important? Well, we used, 30, 40 years ago, if you had a stroke, heart attack, or cancer, people passed away from those things, right? Now people live. And so your quality of life may not be as good as it was previous to a stroke, heart attack, or cancer, but you're still alive. And your quality of life now, after, needs some certain care. And you may need some additional dollars. Well, you can have access to a percentage of the death benefit in this situation. Now, do you have to tap into any of these? No. If you're in a situation you need it and you have it, you can use it. If you don't, you're not required to use it. Now, here's where we use it as an asset. Okay. Now, remember, this was from talking from a death benefit perspective, what your dollar can do. Okay. Now, let's shift this to, instead of quote unquote life insurance, let's start talking about the cash value part of life insurance. Now, that's what the CV stands for. It's cash value. This is what we call our asset accumulator. This is where we're building up equity. Okay. Now, how we build up the equity, we'll discuss in the different types of ways that can happen. Okay. But this is where we build up. So that dollar, not only is it giving you these other 4 living benefits and then 3 living benefits and the death benefit, but it's also giving you equity buildup. Now we have the ability to create an income stream from that equity buildup. Okay. Now again, properly structured, designed. These are not blanket statements. This is just education. Your situation is going to be different than the person next to you that is watching or listening to this. Okay. Extremely important to understand. This is where the due diligence and the planning and the designing of the plan is really important. We'll talk about that in a few minutes. And so the income stream actually can come to us from a income tax-free strategy or structure if it's properly structured. And again, we'll discuss that. Again, this is not a blanket statement. This has to be based on your personal situation and what we look at and design for. Okay? So let's go ahead and talk about the basics of life insurance. Okay? Now we're putting on our student hat and we're looking at Insurance 101, Life Insurance 101. Okay? So there's 2 types of policies, 2 types of life insurance, term and cash value. Okay. Now I'm using the word cash value. Some people will use permanent insurance, okay, in place of cash value. It's the same thing, all right? And I'll explain that as we go through. Okay. So now what we want to do is let's talk about term insurance first. Term insurance is pretty basic. The most policies of term insurance I'm going to explain here is what we call level term. Okay, level premium term, and it's temporary. It's for a term. It's a period of time. So 10, 15, 20, and 30 years are the common ones. Now, there are some carriers that will do odd year numbers, but in general, it's 10, 15, 20, and 30 years. And now most carriers, it's 10, 20, 30. Okay, but again, that gives you an idea. It's just a period of time. All right. It starts out inexpensive because it's a level, we're just paying for the death benefit. Okay, but it becomes more expensive after you exit the term period. So let's say after 20 years, I decide I want to keep it. It's every year you turn older, the policy anniversary, it's going to increase the premium. Okay, and there's no cash value. It's just like renting an apartment or renting a house. You're just renting the life insurance for that 20 years. Okay, in this example, all right? So let's move on to cash value life insurance. Now, within cash value life insurance, there's different designs. There's two basic designs, whole life and universal life. So what we're going to do is we're going to talk about whole life first, okay? Now, whole life, same scenario. Let's say I have $1 million death benefit. It goes to age 120, so that's why we call it permanent, okay? Now, there's level contributions. And there's not a lot of flexibility with these. And the reason being is because there's a lot of guarantees with whole life insurance. Now you can get cash dividends, and that can allow your cash or your equity to build up a little bit quicker than the guarantees. Now, the guarantees depends on the carrier. It could be anywhere from 2% to 4%, depending on the carrier for the guarantees. Now, the cash dividend, it fluctuates as well based on the carriers. These dividends are paid out based on the profitability and the financial strength and good stewardship and prudence of the insurance company. Okay. Now, some people who don't like whole life insurance will say, "Well, that's a return of premium." Well, you can even state that with stocks and bonds, right? It's a return of your investment. So the reality, though, is that what's happening is that when an insurance company puts these policies in place, they do all their underwriting. And they already have money set aside in reserves based on their actuarial tables of how many people are going to die within that year and from what. Okay. Now, if they do a great job of underwriting and they bring on good business and they don't have a lot of claims and a lot of deaths that they have to pay out, they do a great job on their investment income. Their reserves can be invested and they create investment income that offsets the expenses of the carrier as well. So if they do a great job, they can return those dollars back to you and build your equity based on these dividends. Okay. So that's kind of a high level explanation, if you will. Now, you can increase the cash buildup and you can do what's called paid up editions or paid up policy designs where you, instead of having your cash build up to age 100, you can have it build up to age 65. Now, granted, if you're going to have higher cash sooner, then that means you have your premiums or your contributions are going to be higher as well, right? And you can actually have your cash exceed your original death benefit, but notice the death benefit is still increasing and is more than the cash value. This is extremely important according to the IRS guidelines 7702. This is what we call our tax corridor. What the IRS is basically saying is that the death benefit, because this is life insurance, the death benefit has to be greater than the cash, the equity. Why? Because it's life insurance. The moment that equity exceeds the death benefit, it ceases to be a life insurance policy traditionally and becomes what's called a modified endowed contract, meaning a MEC contract. What that says is that now the cash is no longer available tax-free. It's actually taxable, kind of like an annuity or an IRA or something to that effect. So now it becomes a quote-unquote savings vehicle, all right? So we want to make sure that we stay within this tax corridor. Why I was stressing earlier, properly structured. Okay, we want to make sure it's properly structured, all right? So now let's move on to universal life. There's different types of universal life, okay? And I'm not going to go into the history of why these came into play. That can be done in a different time. But what I want to do is just focus on the similarities to whole life, okay? Now, notice I highlighted flexible. Whole life allows us to have flexible premiums and not level, okay? There are guarantees and non-guarantees. Now, traditional universal life it's an interest-based structure. So your equity is built based on interest rates. So in a low interest rate environment like us right now, these aren't necessarily a great strategy to build equity within a policy. Now, it is a great strategy to use to create what I call lifetime term. meaning that we can create a term policy utilizing this type of structure, much more cost effective, and it'll last the entire life of the person looking for this coverage. Again, blanket statement, depends on your situation, just throwing that out as some information. Now, the other type is called variable universal life, or VUL. Variable universal life, same structure, permanent, flexible premiums, guarantees, non-guarantees. Now, the non-guarantees, instead of interest rates, it's based on what's called separate accounts. The equity is built on separate accounts, similar to mutual funds. Okay, so your equity can go up, it can go down within this. Okay, so so if you're in the non-guarantee, your cash actually can go down and actually be lower than what you actually put into it from a contribution perspective. Some people love this, and some policy designs are great. It really depends on your situation if this is something that you're interested in. You may have one of these and you didn't know why this is the way it is. So again, this is something that could be reviewed and analyzed later on. Okay. Now the third type is kind of a hybrid of the first two, of the traditional universal life and a variable universal life. This is called an index universal life. So all the same things, permanent, flexible premium, guarantee, non-guarantee. Now the non-guarantee is based on an index. And so in this example, we're going to use the S&P 500 index. Why? Because it's commonly known as the 500 largest companies, U.S. companies. It's recognized by more people, okay? Now, there's some nuances with this that I'm not going to go into right now, but the bottom line is that we're going to just use the S&P 500 index as our example, okay? You actually can use other indexes, but this is going to be our example. So remember, with the VUL, or mutual funds, or even the S&P 500, your money can go up, it can go down, right? They're market fluctuations, okay? So in this structure, we have three areas that actually allow us to protect or allow us to control the equity build up and how that's going to perform. The first thing is called a floor. What that means is the minimum that if the market goes down, see the red dotted line, we actually can lock it in. See this line here, how it goes level, goes straight? We can lock it in. Our floor typically is 0. Now some carriers, it could be 1 or 2%. Okay. Now, again, properly structured, it depends on the design and what we're trying to accomplish. But in this scenario, let's just say it's 0. Okay. So what's happening is that if the market, the S&P 500 goes down, then what happens here is your cash is just locked in. So the equity in your policy won't go down based on the fluctuation of the market. Now, there's something called cap. What the cap is based on a financial structure of the design of the policy of how the carrier is going to increase the equity. Okay, they call it crediting. Now the cap says the max you can get credited. So it's based on how the S&P 500, and again a lot of nuances that we won't go into here. But the cap, let's say it's 10%. What that means is that anywhere from 0, the floor, to 10% is what you can get credited to your policy based on how the S&P 500 did. So let's say the S&P 500 went up 8%. Well, you would get 8%. Let's say it went down 8%. Well, the floor would kick in at 0. Now let's say the S&P 500 went up 12% and your cap is 10%. Well, you would get 10%. All right. Now that's important to understand. Now, what if the S&P 500 goes 20% and you have a 10% cap? Well, you're going to earn 10%. That's your credit. Okay. So that's why carriers all of a sudden created this third area called participation. What this means is that you can actually participate in the increase higher above the cap. Now, sometimes carriers will say you can participate 100% up to a higher cap, let's say 15%. Some carriers will say let's have no cap, and you can participate in the S&P 500 by 60%. So if the S&P 500 went up 10%, well, you're at a 60% participation, you get 6%. But let's say that you're at 160% participation and it goes up 10%. You actually can get a higher percentage, 116%, based on the participation and how these are structured. So again, these aren't blanket statements. These aren't saying that every carrier does this and all this kind of. It's properly designed. It's based on your current situation and how we go about looking at this. But this gives you a good idea. So let's look at a visual here. This is actually a snapshot of Yahoo Finance. It's not important any particular year or anything like that. We're just using this as a snapshot, as a design of how this works, so you can visually see it as well. So each blue arrow represents a year. And the jagged blue line, the light jagged blue line, represents what the S&P 500 was doing. Okay, so in this particular, the first year, it went up. So the green arrow represents up. Okay, so the second year did the same thing. Now the third year, the red arrow shows it's going down. That means the S&P 500 went down from the beginning of the year to the end of the year. So notice the yellow arrow, that represents your floor. That's your zero. Okay, so the next year it went down even more, so that's why we have a red arrow. Notice your yellow arrow goes across this another zero floor for a second year. And then at the end of that year, it goes back up. So notice the green arrow, and so therefore your green arrow goes up. Okay, so this kind of gives you a visualization of how this actually works. Now we're not talking about floor percentages, we're not talking about cap percentages, we're not talking about participation percentages with regards to this, whether this is better or worse than the S&P 500 index or whatever. That's not the conversation we're having. This is just an education conversation of saying, here's how it works. If this makes sense for you or not, I don't know. And that's where due diligence comes into play, okay? So I'm not saying that do this and go out and figure out that if this is something you should be doing or not. This is just educational explanation purposes, right? It's not to be construed as a promise or to be accurate about anything, okay? So now what do I do now? So this third thing you're going to learn from this webinar is, what actions should I take? What actions should I take? Well, let's talk about that. How do I start? Right? That's the action. How do I start? Well, the first thing we'll do is that if you decide to reach out to us, and we'll give you our contact information, if you decide to reach out to us, there's a couple things we're going to do. The first thing, we're going to do an analysis of your current assets. We want to take a look at a snapshot of your current situation. What's it look like? What's your income look like? What assets do you have currently? Are you earning income from these assets? What kind of assets are they? What kind of income will be generated, and the taxation of those assets, okay? So as we're going through the assets, what we're going to do is we're not just going to do an analysis of your current assets, but we're going to show you how those are going to be taxed currently if you're to just draw income out of those right now, okay? And then what we're going to do is during this analysis, when we meet with you, we're going to show you how they perform. We're not going to tell you what you have is good or bad, right? We're just going to teach you what you have, how they're going to perform, how they're being taxed at later on when you need them based on your situation. And then at that point, you can decide, hey, Bob, I remember our webinar. Can you tell me what steps we need to take to move forward? Sure. Okay, so then we'll plan a design and figure out what that makes sense. Some people it may not make any sense. What you have right now, you need to keep doing based on your situation. Now, you may be somebody where you have a bunch of different types of assets, different incomes, 4 or 5 businesses, or whatever your situation is. Well, then your situation is going to be a lot different. There may be some other options and ideas that are beneficial to you. And so that's what we would go through, is look at some of those from a high level and kind of do some education of what you have and what you could be doing. And again, it's up to you. You're the boss. This is your money, right? If you decide to proceed with us, then you hire us and we work for you. You're still the boss. We'll be your CFO, if you will. And so that's basically how we would start. Those are the actions that you need to take. Now, another action you can take is do nothing. Doing nothing is doing something. Doing nothing is a decision to do something which is nothing. That's clear as mud, right? Now, all of a sudden I became Dr. Seuss. It's an important thing to understand. Procrastination actually is an economic termite. It affects time, which is the third major economic termite. So you don't have to do anything. Therefore, you just did something. And we're not telling you you need to. We're just providing advice out there because we want to be able to be of service and help as best as we can. So here's your next step. call or text us at this number, 833-872-3762. Okay, write this down, 833-872-3762. Call or text us there. Due to the activity, you probably will not get a human voice. You'll get a voicemail. So it may be better just to text us at that number or send us an email at the email address info@assetcoach-taxstrategist.com. Okay. Again, info@assetcoach-taxstrategist.com. And just tell us you're interested. And of course, leave us your contact information so we can get back to you. And we'll take that next step. Or you can click on the link that is directly to our calendar and schedule a 30-minute strategy session with us to discuss your situation. See if you qualify. See if it makes sense. Ask us questions. We're not telling you to do anything other than do due diligence. Do some research. The stimulus packages that are being issued are going to create a tax bloodbath later on. And taxes will and have to go up in order for our country to continue to survive and continue to grow. And that revenue is necessary and important for the financial livelihood of our country. You don't need to be a rocket science, a mathematician to know that. It's bottom line. If you ran your personal checkbook the way the country does, guess what? You're not going to survive very long. And that's extremely important to understand. So thank you so much for your time. I appreciate it. I hope this was extremely valuable information for you. My name is Robert Wolf. I'm an asset coach and a tax strategist, and my firm is Terra Firma Business and Financial Consultants. Once again, disclaimer, please do not consider any of this to be advice or suggestions of what you should be doing or anything other than just information for educational purposes only. Reach out to us and let's discuss your situation based on who or what you are and how you may or may not qualify for these ideas. All right. So thanks so much. I appreciate your time, and I will chat with you soon. Thanks so much. Bye bye, guys.